Good evening. We'd like to begin, if we can have your attention. I'm Ron James. I'm the president of the Center for Ethical Business Cultures, and on behalf of the center, we'd like to welcome you to this evening's public program exploring a very timely topic, corporate responsibility and sustainable investing, a new marketplace reality. We're excited to have Tim Smith with us to be our conversation starter, and then of course you're going to hear from some panelists who are very experienced in the area. I'd like to welcome you again on behalf of the center. Our center is over 30 years old. It's located right here in the Opus College of Business at the University of St. Thomas. Our purpose is pretty simple. We really work hard at helping businesses build ethical cultures, working closely with the Opus College of Business, who focuses on educating highly principled global business leaders. We do that through three major areas of focus. One is in the space of research. We're doing some interesting research looking at the characteristics of ethical culture. How does it actually add value to a business? And literally, what does it look like as you go around the world? We're also working on a couple of book projects. You'll hear a little bit about one in just a moment. We do some other interesting things, including public programs like the one this evening. We're elated that you're here with us. David Rodbourne, Vice President of the Center, will take you through the flow of this evening's program. Relax, please enjoy, and then we'll be excited to hear your questions. David?
Thanks, Ron. It is a pleasure to welcome you this evening. I met Tim Smith 2 or 3 years ago, and I can assure you from that meeting, am I buttering you up a little bit here? Yeah. From that meeting and from our conversations today with MBA students and Ken Goodpaster and I talking with Tim, this is going to be a very interesting presentation. Several years ago, we were approached by a major funder who asked one question: is there a history of corporate responsibility? And we kind of hemmed and hawed a little bit and said, well, I don't think there's one recent. And as a result of that conversation, we were able to secure a grant to the University of St. Thomas for the SAIP Institute and for the center. And our role in that is to create a history of corporate responsibility, first in the US, and then later on we're going to look at a global perspective in that. There is a little brief overview of that outside. If you happen to have a chance when you leave, you can pick up one of these flyers that'll give you some idea. You'll have to wait a little bit for the publication. It should come out in about early 2012, but we're absolutely delighted to be working on that and really being able to bring Tim here because he reflects on that whole history in many, many ways. Well, not all the way back to Adam Smith, but the last 40 years anyway. I'm going to first introduce Tim, and he'll talk for about 25 minutes, and then we're going to ask the panel to come up, share their perspectives on this, and I'll introduce them as we start into that portion for about 15 or 20 minutes, and then we'll throw it open for questions and discussion, and I suspect there will be quite a few of those as we go along. Tim Smith is with Walden Asset Management. He is a senior vice president, and he leads their engagement with companies on environmental, social, and governance issues. So he's right in the thick of it when it comes to talking with management and I suspect occasionally with boards about ESG issues and creating a conversation in which they can look for some common ground and find a solution that is acceptable to their shareholders, to their business model, and to other aspects of their work in industry. I at one point was thinking about introducing Tim as someone who's moved from the barricades to engagement, because engagement really is now the issue that he deals with, creating that conversation that is constructive. Tim started that work 24 years as leader of the Interfaith Center on Corporate Responsibility. So he's seen it all in a lot of ways, from the debates and conversations about South Africa to Nestle to labor and sweatshop issues, you name it. If you've seen our flyer, you got a feel for what he has done. He's also chaired the Social Investment Forum, and he sits on the advisory board of Kimberly-Clark, looking at the question of sustainability. So I'm not going to go beyond that, but I assure you that Tim's experience brings a wealth of knowledge and insight to this presentation, and I welcome him to the podium. Tim Smith.
Thank you very much, David, for a very nice introduction, and I appreciate being buttered up. I don't get that in Boston very much. So. It's nice to be here in summer in Minnesota. Hang around, he said. I left from stormy Boston the other day. And I'm very, very pleased. I like the way Ron set this up to be a conversation starter today and to be with a thoughtful panel of responders that we have. So we hope to start a good discussion and dig into this very important topic, which has several parts to it. Corporate responsibility, which we'll talk about in depth, of course, and sustainable or responsible investing as well. And I'm going to suggest at least that that's a new reality in the marketplace. I'm also thrilled to be here at the invitation of the Center for Ethical Business Cultures, which is doing such groundbreaking work and such thoughtful reflection in this exploding field. And that's another point that I think we'll all make on the panel, that this whole arena of work is expanding mightily and very quickly. So you heard a little bit about my background, so you have a sense of where I worked and what I did, and I think you have a sense of what my biases may be then too, and it's always helpful when somebody is speaking to you to have a sense of what their perspectives are, but what their biases is too. So having worked for 40 years with investors, obviously I'm approaching this discussion as a concerned investor advocate on environmental, social, and governance issues. So I work now for a for-profit investment firm. We have about $5 billion of assets under management in our company, Boston Trust and Investment Management, of which Walden is a division that focuses on helping clients that are concerned about environmental, social, and governance issues. So working in the for-profit world, having worked with religious investors, the Interfaith Center on Corporate Responsibility, which are Roman Catholic, Protestant, Jewish organizations. I worked there for 30 years in New York, and they have about $100 billion of assets under management. So they're concerned investors as well. So you can see that my bias is reflected having worked in that community. But you also heard that I serve on the Sustainability Advisory Board for Kimberly-Clark, which is a fascinating experience. I'm learning a lot from it. Here's a company who's marching down the path to being a more sustainable, responsible corporate citizen and wants to invite input from stakeholders, from different thinkers on this. And we meet with them regularly to talk about that, including with the CEO. And finally, I sit on the board of the General Board of Pension and Health Benefits of the United Methodist Church, which is also a significant investor, has about $14 billion of assets under management. And they're also one of these institutions on which I'm going to reflect that are working on a dual purpose, looking obviously to protect the beneficiaries, the pensioners, but also trying to be responsible to their faith guidelines and backgrounds. So all these work together. So as I said, we'll focus on two very connected but separate realities. I'm going to start off with talking about the growth and impact of sustainable investing. And if you read this in the press or Googled this, you'd feel, and I'm sure you'll hear this from my colleague Aditi from the Calvert group too, that there are different investment firms, different pension funds, different universities, foundations, religious groups will use different language to describe this reality that we're talking about this afternoon. Some might talk about, and this was the historic language, being a social investor. More likely now you'll hear investors talk about being a responsible investor. Some would talk about being ethical investors. And you're going to hear the ponderous phrase often of being an ESG investor, looking at environmental, social, and governance issues integrated into the investment process. But we are talking about the similar reality. So I'm going to start off with a thesis. I hope I can make it to you in a convincing way and that it makes sense to you. But the thesis is that there's a new, aware, engaged, and involved group of investors that, especially in the last decade to 15 years, are in the marketplace, raising questions with companies, and speaking a somewhat different language than we would have heard traditionally from the investment community. Some of them were awakened rudely by the Enron and WorldCom and so on scandals. Awakened rudely because they perhaps were more passive investors, watching what companies did, but having faith and confidence that the managements that they trusted were taking care of their invested assets. And they were rudely reminded that, in fact, there can be corruption and greed and tremendous problems with some companies that cost them literally billions, hundreds of billions of dollars in the marketplace. That woke them up to be a less passive investor and to be more aware, engaged, and active. And it made them see that it was their responsibility as a fiduciary to do this rather than just sit back and clip dividend coupons, if you will. So this is part of their fiduciary duty as they see it. In this work, and you understand this from my history, I think we're standing on the shoulders of the faith community, which really 40 years ago got involved being an active share owner voice. And being involved in raising questions with companies. Now, Ron, we may be correct, David may be right, that this looked to some companies as if they were investors on the barricades. But I think oftentimes these were investors who sometimes raised passionately moral and social issues with companies, but often were very willing to sit down, talk, and learn from each other. In this range of investors that I'm going to talk about for this moment, you're going to hear different values being represented. The Treasurer of the State of Connecticut, if she was here today, would speak a slightly different language about being a concerned and active fiduciary than somebody from the United Methodist Church or the Calvert Group or the Sisters of Charity. But we come together and work together on very many of the same issues. So, watch this thesis unfold and see if it makes sense to you. A new, involved, aware, and active set of investors. What's some of the, if we read the tea leaves, what's some of the realities that we can look at? The first I'd point to is a group called the Principles for Responsible Investing, called PRI. Created only a few, 6, 7 years ago by a group of pension funds, a group of investors, along with the United Nations. They rang the opening bell of the New York Stock Exchange. The Treasurer of the State of Connecticut was there to do it and went off to have a press conference to announce these set of principles. These principles, we're members or endorsers of these principles, argue that it is your obligation to look at these issues, as I keep on saying, environmental, social, and governance issues. I'll use the short form from now on, ESG, because these issues impact the bottom line and affect share owner value. So it's not a choice, it is your obligation to look at these issues because you're derelict in your duty if you don't. Interesting. So, in terms of making the case today, though, it will interest you to know that this is a global set of principles. Pension funds and investment firms all over the world, from UBS Bank to smaller firms like ourselves. And these investors have over $20 trillion of assets under management. Okay, that's a significant amount of money. I still don't know how to get my arms around $20 trillion. And it makes a point, doesn't it? It doesn't mean that all these investors are knocking on company doors, but it means that they're a constituency of self-declared investors who report on what they're doing and how they're doing it, and it includes the T. Rowe Prices of the world, as well as UBS, as well as folks that you'd consider more active investors. Here's the second category that I think even makes the point more potently. The Carbon Disclosure Project, more initials, CDP, created again about 6, 7 years ago. As its name applies, they are looking for companies to disclose their carbon footprint. In other words, what are the carbon emissions from the company? What is the company doing to reduce its greenhouse gas emissions? All about the environment, all about climate change, trying to put hard data on the record and urge companies to be transparent and open. If you measure it, you can manage it, the old adage that I'm sure you talk about all the time in the school. And we want to see companies being forthright on what their carbon footprint is. But back to the case we're making here about the engaged, involved, active investor, international, global investors again this time, and now we're talking about investors with over $60 trillion of assets under management. And again, the number is so huge because you have such very, very large institutions like JP Morgan Asset Management as part of that group. And I'm not trying to overstate the case. I am trying to say that these investors support this kind of disclosure because they think it's important for them to understand how well is the company run to deal in a future carbon-constrained world, in a future where climate change is upon us and companies are going to have to adapt rapidly. Okay, going on to a third, the Interface Center on Corporate Responsibility. I indicated are investors who may be knocking on more company doors more frequently, $100 billion of assets under management. And yesterday, the industry association that Calvert and we are very active in, called the Social Investment Forum, came out with a new report called the Trends Report. You can Google it under socialinvest.org, and you will see this report looking every 2-3 years. They do a snapshot of the U.S. investment climate and what trends are. And they looked and they saw continued growth. Some surprises to, I think, a few of us, that issues like a terrorism screen was a very prominent screen, so that there's some institutional investors who are looking at things like investing in companies that have a link to Iran. Not an issue I think we've worked on a lot, but it's still out there. But a very high screening issue was companies that are involved in the Sudan, and the genocide in the Sudan motivating many investors, a lot of universities, a lot of state and city pension funds, to say they choose not to invest in companies that do business in the Sudan. So the Trends Report talked about in the U.S. Investors, I think it's around $2.7 trillion who are involved either in screening or shareholder advocacy, or one of the things we describe as community development investing. So a very interesting snapshot of a growing reality. And then what they also talked about is the mainstreaming of this process. And also a point I want to make, that we are talking about the Goldman Sachs's and the State Street Global, State Street Banks, SSGA, huge, huge firms that are involved in this space in some way, shape, or form. And important to watch there. Okay, so I'm going to stress again that the motives of these various investors in these various groups may differ, but oftentimes they'll come to the same place. The state of Connecticut treasurer, I said, will state the case differently than I would or the Calvert group would, but she may be a proponent or an active voice on a climate change issue or an issue related to say on pay, or an issue related to corporate governance, just like we would. So my final point there is, I don't think this is an investor constituency that should be ignored. They shouldn't be ignored in academia. They should definitely not be ignored in the business community. What are the approaches they used? Well, you heard me say it very briefly. Screening. Some of them actually choose not to invest in tobacco companies, for example. Or they screen out companies that are poor performers on the environment or have a terrible labor or diversity record. So these become ways of evaluating a company's social performance as well as its financial return and deciding whether to buy it or not buy it. Secondly, some of these investors, and I'll just touch this briefly, are involved in community development investing, taking a portion of their portfolio and putting it to work to empower poor communities, whether in South Africa or in a Native American reservation or for low-income housing, trying to get your investments to do double duty and have a real social impact. And thirdly, the category of these investors, category describing these investors, would include share owner engagement. So I want to be clear here what many facets that includes. Share owner engagement sometimes appears on the front page of the Wall Street Journal if there's a controversy, but more often than not, it's a private conversation, a dialogue with the company on an issue. It may be a one-time dialogue. It may be a dialogue that occurs over a decade to go over issues. It may be a dialogue or an engagement that includes stakeholder groups. So it's possible, if we're talking about an international development issue, that Oxfam might be at the table, or a development group, as well as investors, as well as the company. And oftentimes, these investors would actually go the extra mile and sponsor shareholder resolutions, which are taken to a vote at stockholders' meetings if they're not negotiated and a win-win agreement isn't found. On rare occasions, this elevates to a very, very controversial kind of approach, and you'll see some investors starting a vote no campaign. Vote no against Director X at Massey Energy because of their absolutely terrible safety record. Vote no against a director at Occidental Petroleum because they're giving away the store in terms of the executive pay for their CEO. So you'll see that happen rarely too. It's obviously more confrontational, obviously more in your face. But the vast majority of engagements, I think, are either private persuasion or respectful public dialogue. There's absolutely dozens of issues that these investors are involved in, from diversity to food safety, from human rights like the Sudan, which I mentioned a moment ago, to fair labor standards in factories overseas, from the issue of climate change and the environment, to good governance practices and executive compensation. So I want to sort of finish with this section by just commenting briefly on, do these engagements, do these resolutions make a difference? And the answer, of course, varies tremendously, all the way from not at all. The company is free to ignore them. You don't have to listen to your share owners just because they own your stock. You can ignore a shareholder resolution. You can ignore a letter. You can ignore a request for a discussion and just say, I prefer not to engage. I prefer not to be engaged. But the vast majority of companies, and this is a trend I think we can watch, take their share owners seriously. They treat them respectfully. They're willing to talk to them, answer their questions, engage with them. Management would try to engage and inform and educate share owners, and likewise would be open to hearing new ideas and perspective from owners too. So in many, many cases, these resolutions or engagements are successful because they open our minds and our eyes, and they move the process down the road. And often when these resolutions are filed, they're withdrawn because you come to a win-win agreement. Yes, we'll agree to do this report on sustainability. Yes, it's a fair idea to have a commitment to more disclosure of our political spending. Yes, we agree to change our policies or our practices on a certain issue, like giving investors the right to have a vote on executive compensation. So whatever the issue is, there is a history of experience where share owners, having engaged companies, find this kind of positive win-win experience, and the resolution becomes put on the sidelines as we move forward. There are issues that are fairly mundane and not mundane, but reasonable kinds of things where we're asking companies to require that directors be elected with a majority vote. I think it's fairly reasonable. And then there's controversial issues, especially here in Minnesota, about resolutions that focus on companies that have provided contributions to Minnesota Forward or the Chamber of Commerce, and discussing, debating the political contribution issues. Okay, let's change gears. Let's look for the moment at businesses and corporate responsibility. And many of you in this room are working with companies that have a very strong forward-looking record on corporate responsibility, and could easily make this lecture more interesting than I. So whether you're talking about companies like General Mills and Target or Best Buy and Medtronics, these are companies that get this, have a story to tell, are examples for other companies too. The business case I want to make, just like I was making a case that share owners were more involved and engaged, I want to try to make the case that the business case is compelling, especially for large companies globally, to be leaders or strive to be leaders in corporate responsibility. I even harbor the hope, and I think we might be close to a tipping point internationally, where large companies are acknowledging that being good corporate citizens is good for share owner value and advances the bottom line and is also the right thing to do. That we see scores, hundreds of companies who publish reports on corporate responsibility or sustainability and make exactly that point. It is not simply doing the right thing for society, it's also advancing the company's interests and advancing the bottom line. It's smart business, often with tangible benefits, sometimes cost savings or business opportunities. So the business case, the points that companies absorb, report back, explain quite clearly why it is a mandate for them to act, have multiple points. The majority of S&P 500 companies now actually declare their commitment to act as a responsible corporation, and they do some kind of CSR or sustainability reporting. Now, we know definition. I told you that the definitions or language might differ with investors who are involved in this ESG investing space. Likewise, in the business community, people might just define this or emphasize things differently. That's fair and right. IBM has a somewhat different focus on what it should be doing than a Nike or an ExxonMobil. I mean, because of the virtue of its business. But it's still all about doing one's business in a responsible way. KPMG reported just a year or so ago that 79% of the largest 250 global companies do CSR or sustainability reports now. It's important, an important factoid, and it's growing. So why do companies do all this work? Well, let's check off some of the reasons. I think most companies would say it decreases regulatory and litigation risks. We only need to look at Walmart's difficult situation with 1.5 million women in a class action against the company to understand that if they lose this case, they and we as shareholders are going to pay a mighty price. So in this case, discrimination, if Walmart loses or has to settle, will affect the bottom line. A company that's a leader and takes seriously these issues, whether it's the issues of the environment or whether it's the issues of diversity, is actually protecting its reputation, is decreasing regulatory and litigation risks. It is avoiding, as I said a moment ago, reputational risk, but it's also building a public trust, isn't it? And especially for companies in this room who value the consumer and the consumer sense of who they are and what their reputation is, this is very important. We just need to be reminded that Coca-Cola tells us all that they don't sell soft drinks. They sell a brand. And their brand is very, very precious and is worth billions and billions of dollars. And they strive mightily to protect it. In this economic meltdown, it wasn't just politicians and people in the church, and I don't know if academia suffered in terms of reputation. But the business community has. Those of us in the investment community, those of us in the business community saw the trust of the public decline. I'm going to suggest that companies and investors who try to talk and act in ways that are demonstrating a responsible corporate responsibility are working to rebuild that trust in a way that will rebound well for them. It reduces costs and enhances revenue. Again, the obvious examples that any company in this room that have turned their attention to reducing energy costs and retrofitting lighting can point to, this saved us money. Well, then it's not almost a corporate responsibility issue, is it? It's like, hey, you're supposed to be doing this because it's the smart business thing to do. But indeed, this is part of the business case. Leadership in CSR can improve a company's efficiency, productivity, competitive edge, long-term survival. And I think it helps attract labor, investors, and consumers. So that's a big, long list, but I think it's still arguable. You need to look at who your peers are and what they're doing. This is a competitive world, and businesses that are, especially are watching what their competitors are doing, who are trying to go after the same consumers, are paying attention when their competitors are trying to get that little edge forward by being responsible. I also think it helps in recruiting and retaining labor. We had a fascinating discussion this afternoon with folks from the net impact chapter here. And I recounted the fact, and they were repeating too, that they thought that many companies were paying more attention now to these issues when they promoted the company and were seeking to hire new employees. But we've heard again and again in the business case that companies make that this matters more and more to younger employees who are just coming out of business school, and that therefore they want to be attentive to that constituency and have a story to tell. It's part of the business case. And finally, it's being responsive, to the kind of investors that I described earlier. It even has advantages in retaining or recruiting customers. And finally, and this may be the most telling point, isn't it? So the point I'm making as an investor can be heard by the company, respectfully received. But what happens if you're a supplier, a company who supplies Walmart? Or you supply Pepsi? Or you supply Ford Motor Company? And each of these companies has a supply chain policy that says to its suppliers, tens of thousands of them in Walmart's case, this is what you shall do if you wish to be a supplier of Walmart. You shall be transparent in your reporting, and you shall be taking account of reducing packaging, and you're going to take these steps on the environment. You know, so even if you didn't have it on your chart of things to do, suddenly if you want to keep your relationship with Walmart or some of these other companies on a positive level, you start paying attention. And it's fascinating to me that companies that we talk to in one year and urge them to do a sustainability report say, well, I understand, but it takes time and energy. We don't want to do it. And the next year they'll come back and they say, well, we think we're going to do that report. We said, well, good, we're glad. And why is that? And he said, well, Walmart told us we had to do it. So, I mean, this is, I mean, we're trying to influence, but some companies would even say Walmart's more than influencing, they're requiring it. This is a different context for companies today. The business case is strong, but it's also, there's an economic tsunami, isn't there, that pushes companies to be more responsible too. Okay, in conclusion, I think there are these new realities in the marketplace with investors raising new sets of questions and urging changes in policy and practice. There are rapid and exciting changes in business leadership on corporate responsibility as well. It's on the move, and neither of these trends are fads or genies that are going to be stuffed back in the bottle. They're new realities, and they stand on the foundations built decades ago in business and by some investors. So it's a special privilege to be with you today. I look forward to the conversation of my fellow panelists. I will.
If I could ask the panel to join us up here at the front, I'll give you some insights into who they are, and we'll move to that portion of our program. On my right, your left, I have to kind of double check that, is Caterina Glock. She is an assistant professor of business ethics and law here at the University of St. Thomas Opus College of Business. She has degrees from Friedrich Alexander University in Nuremberg and the University of Pennsylvania as well. And we're delighted because she assisted us on the history project by writing a paper, a working paper, if you will, on the influence of shareholders on corporate social responsibility. You know Tim. Next to Tim is Aditi Mohapatra. And Aditi comes to us from Calvert Investments, where she is a sustainability analyst. She also happens to be the author of a very recent report just put out on board diversity. Asked her if she wanted to autograph copies, but I'm not sure she's got any with her. But Aditi has degrees in finance from George Washington University and the University of Florida. And she works on diversity issues and gender issues with companies in engagements similar to those that Tim gets involved in with companies around the country. On my left is Trevor Gunderson. Trevor Gunderson is with General Mills. We're delighted to have him. He is Vice President, Associate General Counsel, and the Assistant Corporate Secretary at General Mills. And when I called him and at someone's suggestion, Linda Serrano, who's one of our board members, suggested I give you a call. He said, "Oh yeah, I know Tim." So I think we've found another one of those instances where these engagements and these conversations have been going on, and productive ones at that. So we are delighted to have Tim with us as well. He has a law degree from the University of Minnesota and a bachelor's in business administration and accounting from the University of Wisconsin, Madison. So, Madison?
Yes.
Yeah, okay. So I'm delighted. I've asked each of the panelists to speak for just about 5 minutes to kind of reflect on what Tim said, but also to enter their own ideas and perspective into the discussion. And then after that, we're going to throw it open and have a discussion with you as well. Katherina, would you like to go first?
Okay, I think this is working. Well, of course, when Tim was speaking about new realities and new phenomenon, so to say, that's always what researchers get very excited about. And we latch on to this and try to understand how did this all come about and what is going on, what is happening. And that was the case in my case as well. So I wanted to understand my own research. Well, what is it about these ESG or concerned investors that makes them become engaged and stand up from the crowd? Now, of course, we heard the story that there might have been a rude awakening that made this happen, but I try to sort of take a look at the decision process and how it is that they go about expressing the expectations that they have of corporations in a more active way than just sitting on the sidelines and perhaps observing. Now, of course, it was exciting for me to hear that from various organizations, this is really becoming mainstream and corporations are listening and it is having an impact, and that's certainly what I have found as well. But I did want to bring in a few things from my own research that make me be a little bit concerned. Well, not too concerned, but at least sort of watch out for some things that might be a challenge for this movement to continue further. And so I just want to share with you a few things that I have found in my own research. So this is definitely the perspective from the academic, and I would love to hear how this actually works out with investors, because all I get to see are questionnaires and bubbles that they filled in. But anyway, I was interested to observe what diversity there was among investors in their expectations of corporate social responsibility. And I saw this first when I looked at how many socially responsible funds there were. So there were some now 200, I think, as of recent counting, which just goes to show that, yes, while all these people come together and they might coalesce around similar issues, they do pull on different strings with different strengths. So there's a fund pretty much for every flavor, if you will. There's an environmental fund and a women's fund and various religious funds. So this type of diversity, of course, the traditional finance community took as a sign that, well, of course this can't all work, because, if everyone does something else and tells the corporations to go in a different directions, how on earth can they get the message that some things are really more important than others? But when I surveyed the investors, I also saw that pretty much all of them, regardless of whether they engaged in SRI or not, had pretty high expectations of what corporations were supposed to do. It was just that they happened sometimes to act on it and sometimes not. And one of the interesting things that I observed is that there seemed to be, at least in the data that I had, two different groups or different opinions or divergence in opinions on really what the role of the corporation in society was. And that was fascinating, because one group of investors seemed to think that corporate social responsibility is really more of an issue of avoiding externalities. So don't pollute, make sure you have a diverse workforce, don't go into countries that violate human rights and things like that. And that notion of corporate social responsibility really did find expression through the socially responsible investing. So these investors tended to really act on these views. But then there was another group of investors who saw the corporation as much more socially activist. So they expressed desire that corporations really actively improve society and go out and improve the living conditions and improve the condition of minorities in their workplace, that sometimes even some corporations should stop to exist because they produce harmful products like guns or nuclear power. So, but in those cases where that view was more prevalent, that didn't seem to find expression through the investment outlet. So I thought that might be interesting, that either there is sort of a limit that investors see of what we can ask corporations to do at this perhaps early stage, or that there is just right now sort of a building consensus about what corporate social responsibility really consists of. Because I do think that, you know, when we talk about terminology, we have kind of an inkling, and there's institutions that provide data about corporate social responsibility that drive a growing consensus of what the good corporate responsibility consists of. But there are still people who think corporations should do more or less. And so I think one of the challenges of the movement will be to perhaps start building more consensus to bring even more people in who might right now feel like what they are expecting is not quite represented just yet. So this was one of the challenges, and I think I might have another minute. The other challenge that I found is that while there now are many different funds available for investors to engage in, and many institutional investors are picking up corporate social responsibility issues, I found that investors still expressed a concern that even though they might want to act on what they do, they don't have enough information. So the information aspect about what social responsible investing is, how it works, what institutions there are, whether it's standardized, whether we have some organizations that monitor the quality, that there was some reluctance to engage, not having some more of that information. And that goes hand in hand with sort of the intermediaries in the market that maybe pick up the individual investor. And I'm not talking about institutions now here, but really the individual who makes decisions and goes to a financial advisor, who might still have a kind of a divided mindset about what is appropriate to advise an investor on and what isn't. And in sort of this mental framing that I have called this phenomenon in my own research is still quite prevalent, and this might be hard to overcome. And those investors we might be able to bring into the mainstream if something changes as well about how the infrastructure and the intermediaries engage with investors going forward. So I do have high hopes, but I do see some obstacles that yet have to be overcome.
Thank you, Caterina. Could we move to Aditi?
Sure. So, hello everyone. Thank you for having me here today. So in my role, I'm responsible both for conducting research in terms of the screening process for companies that are eligible for investment in our funds, and that focuses on environmental, social, and governance factors, and then also doing a lot of the shareholder advocacy that Tim has mentioned as well. So I think for our company, for Calvert, we've seen investors interested in both. We have a large investor base that is a traditional investment base that is very much there to align their investments with their values, and they don't want to see us investing in certain companies. So in that position, what I do is I screen companies. I screen companies across 7 different issue areas. I look at companies' policies, programs, and ultimately how that translates into performance to consider them eligible for investment in our fund. So we have a double diligence approach. It's analyzed on the financial side, then it comes over to our department where there's 15 analysts that focus purely on sustainability analysis. We're all divided up by sectors. I cover the technology sector primarily, and I understand what a company's sustainability impacts are going into that corporation. So if you manufacture computers, I look for an environmental policy, I look for environmental management systems, workplace safety issues. And so understanding that, I benchmark them against their peers and decide whether or not they're eligible for investment. But we're often also finding this new investor that also is very much more interested in creating change through their investments. So really investing in corporations to create change. And we have funds that also focus on that. And that is where we see that there are definitely weaknesses within companies. Not all companies are perfect, and not all of them meet kind of our perfect scorecard. And so what we do is we use our role to engage these companies to improve their performance. We think that this really helps companies address upcoming risks that they may face. We often I find myself having to build a business case for a corporation when I bring some of these issues to their attention. Sometimes it's just about benchmarking the corporation and telling them that their peers are doing it and that they're not doing it, and so they could really be seen as a laggard. But more and more, we're seeing companies come to us and ask us, how can we be eligible for investment in your funds? We want to be eligible. We see it as a sign of approval. And I think that that's really a reflection of, employees. I think employees are very much asking for companies to have these processes in place. I think it's also a function of the much more free flow of information. So when a company does something in China, people are going to find out about it much more quickly than they used to. And so as that information is really opened up, companies are much more sensitive to people's reaction to that information. And I think that there is still I guess, a lot fewer investors that are knowledgeable about socially responsible investing. As I go around and as I speak about what I do, it often is a lot of learning. A lot of the individual average investor is not necessarily informed about these issues. And I think that when investors go to financial advisors, unless a financial advisor tells them about this, they have no idea. And a financial advisor will tell you, unless an investor asks for it, we're not going to tell them about it. So, I think that definitely is a challenge, and that's something that I see on a daily basis in my position as well.
Could you make a comment about your recent board report?
Sure. So Calvert recently issued a report, which I authored, focused on the diversity practices of the S&P 100 companies. And so what we did is we benchmarked the largest U.S. companies and provided ratings. So ratings always get companies to move. And I guess it was unique because an investor was doing this for them, so an active investor, not a research organization, but we obviously are investors in these corporations. And, we saw... overall, women still represent only 18% of S&P 100 director positions. Out of the 100 companies, 54 of these companies had no women or minorities in their highest paid executive positions. So we haven't seen a lot of change in that area, and these, again, are the 100 largest companies. What we also saw was a real lack of disclosure on the part of companies, and as investors, that's all we rely on. Publicly disclosed information. It's what is the essence of all of our research. And so, in terms of the demographics of their workforce, 37% of the companies won't even tell you the percentage of their workforce that are women. They won't tell you the percentage of workforce overall that are minorities. So it's really challenging for us to really determine how well these policies and programs companies are putting into place, how they're actually being implemented, and if they're actually having an effect. We see that they have all these great things on paper, and often that's what we're challenged with. How do you know these things are translating into performance? And to be quite honest, it's a challenge, because without the data, without the disclosure on the part of companies, it's extremely hard to find out if those policies are actually working. So that's just a bit about that report.
Aditi, thank you. We've heard a research perspective and two perspectives from the side of the investor making engagements with the companies. Trevor, I guess you get to be the voice for the other side of the table, if you will.
Right. At the risk of not inviting correspondence from either Aditi or Tim, I will offer a perspective in the context of our discussion about the impact or the influence of investors on setting a CSR at corporations. And my starting observation about corporations, as I've seen them and at where I work in other places, is that the board and the management of these corporations are genuinely focused on doing what's in the best interest of the company and its shareholders. And creating long-term shareholder value is foremost in their minds in the actions they take and the deliberations they have. Admittedly, foremost in those discussions and considerations are the financial performance of the company and the growth of the company over a long-term period of time. We talked a lot about CSR concerns, but I think fundamentally companies and management are often focused on financial concerns, and I think that's all right. I think that's what largely investors are demanding, and that's what boards and companies are accountable for. I would say that, again, as a general matter, and at the company I work at, I think it's the case that financial considerations don't predominate to the exclusion of all other interests. We're very concerned, and I think most companies are, about the communities they work in, their customers, the consumers in our case, our employees. Our corporate ethic and our corporate ethic brand are important to us, and those are considerations that for the board and thinking about the long-term interest of shareholders are also considerations. Included in that, of course, are our policies in the CSR environment. Now, when it comes to setting the actual CSR policies, whether it's environmental or sustainability or human rights or labor issues, there's an awful lot of influences that go into how those policies get set that go beyond investors. We hear from consumers who have concerns about our impact on the environment, about the nature of the ingredients in our product, about product safety concerns, and a whole host of things. And as Tim alluded to, we get those letters from companies like Target and Walmart and McDonald's that have their supply chain standards, and we're responsive to those things. We hear from special interest groups that have nothing to do with investments, that aren't our customers, that aren't our consumers, that are particularly interested in, for example, animal rights or the environment. They play a big role in how we think about what our social and environmental policies are, and I suspect that's the case at a lot of companies. But certainly our policies are set also by interactions and engagements with investors. And they're the socially responsible investors and the activist investors who come to us with concerns. As we think about the influence that investors have amongst all of those constituencies on how our policies are set, I think it's helpful to step back quickly and think about, Tim alluded to this, so he's sort of undermined my argument here a little bit, but think about who the investors are. In our company, we're largely institutionally held, and I think that's the case for most large companies, and you're made up of index funds who own everybody, and they're huge, and they can own 3, 4, 5% of your company. You've got mutual fund complexes that invest largely on fundamentals and business results. You've got state pension funds. They tend to have some more socially motivated investment theses. We've got quant shops that just invest in you based on financial algorithms and aren't concerned about fundamentals or issues, and they can sometimes be very large shops. So, and we've got socially responsible investors like Walden and Trillium and Calvert and others, and then maybe 20-25% are individual shareholders. So what I would say about that is not all of those investors view these issues the same, and so when you say how do you run your business in response to investor concerns on these issues, it's not as simple as saying what does Walden want or what does Calvert want. Now they're very, very well informed, and I had very thoughtful discussions with them over the years, but anecdotally, I would say in conversations our IR team has with investors and I have with some of the proxy side of investors, some of those large shareholders don't indicate to me that these issues are foremost in their investment decision. And so it's interesting to think about how we decide our policy from an investor standpoint and other constituencies, but it's difficult to sort out the business proposition and the investor proposition when the largest investors aren't necessarily putting any pressure on you. None of the shareholder proposals we get come from any of the large investors. None of the letters we get, although I would say State Street and the Vanguards of the world have changed their tone a little bit recently, and we may hear more from them, but the pressure is not coming from those large investors who we think probably are investing more on the fundamentals. I would also say, and I would preface this by saying we are extremely grateful for investors like Calvert and Walden because they tend to be long-term investors, they tend to be stable investors, they tend to be thoughtful investors. We love having them in the portfolio. I can't tell you that I think our company or many other companies behave the way they do and craft their CSR policies the way they do in the interest of attracting those investments. And so I'm not sure what impact that has. Like as I said, we're grateful to have them, and I think they're right on target on many issues, but I don't know that that's what motivates us. So Katherina touched on it a little bit. It leads into the question of what is the role of the corporation in setting policy in these areas. You know, Tim's firm and Aditi's firm think that corporations should be central to that, and maybe they're right. And we see, I think this question is also reflected in the power that's given to relatively small shareholders through the proxy process. For $2,000 investment, you can have your proposal in our proxy. And it's in the interest of making sure that investors have a voice in what happens at their corporations. But I would tell you from personal experience, it's difficult to sort out which of those proposals are brought by people who have an investment concern about our policy and which of those proposals are brought by people who have a broader social concern. And I'm not saying one is right and one is wrong, but it does raise the question of if we have a policy that encourages that and allows that and fosters that engagement through a minimal investment, do we really have a social policy that says it's fair game for corporations to be the vehicle of social change? And again, not making, just for the sake of conversation today, not making a value judgment on that, but I think it goes to Caterina's question about what's the role of the corporation in changing policy on these issues.
Oh, thank you. Okay. We would like to throw it open and invite you to ask questions. I have a microphone and Terry does as well, so if you will raise your hand and throw a question to our panel, we would be delighted. There we go, one right here, Terry.
In the last year, the BP situation, to me, should have gotten a lot more flack from a broad public perspective because of the egregious damage that was done. And I just, you know, it didn't have the consciousness of social responsibility from a lot of the people. So I'm just curious about any of your input on that.
So just say the first part of the sentence again, the flack would come from.
Well, I just think, I mean, what happened to, this is my bias, was horrific, egregious, everything counter to what you would say about being responsible for actions. You know, there just was a lot of stuff going around. And I, as a human being, expected a very large outcry about that. And I didn't feel that there was a really large outcry. And I'm just trying to figure that out, you know, from what you're trying to do in socially responsible investing.
So BP in particular, I actually think in the investment community, it was like a shock wave. But good point that maybe that wasn't expressed widely. I mean, the press was covering every day what was happening, of course, and people were riveted by it. It was a shock wave because some people were trying to figure out, had BP, which was a favorite, by the way, in some portfolios, because on some issues it was a leader, and it was trying to say it was attentive to health and safety concerns. So, you know, was it a grave error that they committed, or was there a systemic problem? And that was the kind of soul searching that went on. I guess I'm agreeing with you that it was a very, very deep concern. Yesterday, for example, I spent the half a day with a group of other investors and several oil companies talking about the dangers of deep water drilling and what they were doing to deal with it. So I think there's a lot of now, and I want to be, to your point, I want to be accurate to say, I bet most investors, not just folks like us, but standard investment firms weren't paying a lot of attention to the dangers of deep water drilling. So a lot of people were asleep. That wasn't a priority issue they were evaluating on a company's environmental record. That's going to change rather rapidly, but it's a grim way to get the lesson, isn't it?
Yeah, and absolutely. And I think the number one question I get at any investment presentation that I do is, were you invested in BP? I mean, everybody wants to know, and it's the, you know, standard of what is considered unsocially responsible, if that's a word.
So were you?
Were we?
Yeah.
Oh, we were not actually.
Terry,
They
there's
didn't pass
mics
our
there.
workplace safety screen, actually. Yeah.
Don't ask me.
Don't ask you. Well, we aren't looking for perfection here.
Companies who can't.
This is for the full panel, and it's more directed towards Trevor, though. The opposite of what you've been talking about in terms of encouraging companies to divulge what they have and so forth. What are the companies doing to educate people on the limits of what they can do?
The limits of what who can do?
Well, corporations, what they can do in terms of influencing their suppliers, influencing the groups they invest in. And let me give you an example. As more companies invest in, say, China, many of the companies there are owned by the government or have some very strong influence by the government, or in Brazil, or in Russia, or in India, just as examples. Which means, as sovereign states, what influence do we here as investors in the United States have on how they operate?
Well, I can answer that a couple of ways. Some of the conversations we have with investors from time to time, and Tim's firm included, have to do with foreign operations and how we operate in those foreign jurisdictions. And those conversations often involve questions about what our limits and restrictions are in terms of what our ability is to influence how we conduct our business internationally. And so I'm not sure if your question is, what can we do to make sure that our operations are appropriate internationally, or what can we do to educate investors about the challenges? Well, we've had those conversations, and almost all of our engagements are, well, let me just back up and say, almost all of the engagements that we have with investors is because there's a perception that we have fallen short on a question. And so the first step in that engagement is an education about what business restrictions there are on our ability to implement what they're asking. Whether it is cultural issues or legislative issues about how labor standards are enforced in foreign countries, or the potential for your business being taken over by a local government. Those are challenges, and that, those are informed decisions that our business and board has made about the risks of doing business in a jurisdiction, which investors like Tim and Aditi may not agree with. And so I think what you're asking about is an engagement process where we do have back and forth, and that engagement often is about exploring areas where we can in fact make changes and have an impact there, but it's they're not always satisfactory outcomes for both groups.
But I think probably many investors are more on the same wavelength that Trevor talked about. They're not asking for unrealistic pie in the sky. They would take seriously the grounding that Trevor just gave about the limits of what a company can do. You can't just snap their fingers and make everything right in a foreign country or in a supply chain, for example. So recognizing those limits, we would then go forward and say, well, how do you move the ball down the field? How do you go further? So that, for example, for many companies, General Mills being one, there's increasing look at their own supply chain and their responsibility. So one conversation we've had with General Mills has been a very difficult area about the agricultural supply chain and how do you make sure there's no child labor or abuse in it. Well, you can't make sure, but you can be a diligent partner to try to make sure your voice is on the right side of influencing that equation, right? And I think probably most of the investors who are putting pressure on companies to be responsible vis-a-vis the supply chain recognize that this is always a work in progress, but we want the companies that we're addressing to be moving forward diligently. Now, here's one of the exciting changes we've seen in the last 10 years. 15 years ago, a dozen years ago, the Nikes of the world, if you ask them about a factory in Indonesia with 28,000 young women making their shoes that they didn't own, they would say that's not our responsibility. We don't own that factory. We're just buying the product. Today, you would never hear a major footwear company, a clothing company, a toy company, an electronics company say, that factory's not, who supplies us, isn't our concern. They would say exactly the opposite. It is our concern. We engage that company. We audit its record. We have principles that we expect the company to live by. We audit its health and safety, its labor standards, its environmental standards, and we're trying to be a force to make sure that company lives up to. Well, you can't ask for much more than serious, diligent work there. There are limits. They can't change the culture of China overnight, but they can certainly try to do their part in that factory. And I think most of the, whatever we call ourselves, the responsible or ESG investing community, are sophisticated enough to take the lesson Trevor gives us, but then we would still push a company to be the best it can be, and within that limit. I want to make just one other point that Trevor makes, because he's absolutely right, and it's a good corrective to what I said, because I was enthusiastically describing this trend and this new reality in the marketplace, but we need to be reminded there's all sorts of other investor realities in the marketplace, whether it's a quant shop or an index shop that just invest according to traditional investment principles and are bystanders in the discussion we're having. It doesn't mean that if you ask them they cared, that they didn't have an opinion. It's just, it's not their job to be a voice. However, the very interesting thing that I didn't mention is when a company is asked through a shareholder resolution to deal with an issue like sustainability reporting or having, giving investors a right to have a vote on executive pay, we see, not those firms necessarily, but we see the middle of this investment community that we talked about at least pick up the pen and vote their proxies. And so what we're seeing is a number of governance issues, the votes are 40, 50, 60, 70% in favor. Well, that means that some investors said, at least I've got a vote, even if I'm never going to write Trevor or anybody else a letter. So that's an interesting new trend too, and it's a new reality that companies face. Companies would never 10 years ago have to worry about a resolution passing or a board member being unseated. Today they can't be totally sanguine about that.
We have another question? Got one over here. Get my exercise, Kelsey.
This one's for Tim and Aditi mostly. When you talk about evaluating companies based on social responsibility being one of the items, most things within that realm are probably pretty black and white of if they are good or not. But one of the things recently that's been big in the news is the idea of the BOP, or base of the pyramid, companies that are starting to develop and sell in areas that are developing, like in certain countries in Africa, things like that. And if that is a good or socially responsible thing. For example, on the cover of Business Week a couple weeks ago was Coke in Africa. So are they're selling there, they're trying to make a profit. Is that what people in Africa need to be spending their money on? And is this something that you consider when you are evaluating the social responsibility of a company?
It's a good question. It's hard to answer just, blank slate, like it's one way or another. It would really always kind of depend on the circumstances. I would say for Coke in Africa, we're still shareholders in a corporation, and there's still the idea that we want to see a corporation grow. So much of what was said earlier about a company moving internationally, we just would want to see them do it in a responsible way. So how are they going into Africa? If there were issues in nations that they were going into where there were protests, we don't want Walmart here. How is Walmart dealing with those communities and those indigenous people maybe in some of those countries? And those are issues that we would look at. Are we judging whether or not Coke should be in Africa? I don't think so. From my perspective, I'm not judging on that. I think, it's a natural kind of movement. And, for instance, there's a lot of technology companies that exist in China. China is very rife with human rights concerns and freedom of expression and privacy concerns. But what we ask companies that are operating there to do is, if they're dealing with the Chinese government, to tell them that they are concerned about these limitations. So you see in some instances where companies themselves, like Google, makes a decision to step out of that country. And I don't think that that's a reason why we would divest of a company, but it would be a conversation with that company, absolutely.
I think you actually raise a bigger picture question that's right to the point. I did want to say at the beginning, when you say a lot of the issues are more black and white, there's sort of a section of issues that, if you're opposed to smoking and you don't want to own a tobacco company, that's a pretty simple buy, right? Or decision not to buy. But a lot of the issues about the environment or diversity or how a company deals with its supply chain is all very gray, or an environmental scorecard of a company, right? So you're looking at a company, you got 25 check areas that you're looking at in terms of the environment. Well, a company could do very, very well in some areas, but have a challenge in other areas. So you might still say it's a very mixed scorecard, but we're going to invest in the company. Maybe we'll encourage them to be more proactive in other areas. So I just wanted to clarify that you're making judgment calls, and sometimes people would find themselves disagreeing with the judgment call. Should you own McDonald's in your portfolio, for example, would be a debate for some. But the last part of your question raised a bigger point, and you'll hear some people talking more in the future about impact investing. And that would be a category of investing in companies that might be part of specific solutions. So that, for example, some people might invest in green technologies or renewable resources companies, and have that as a specific focus of part of their investing. So, for example, CalPERS, the California Public Employees Retirement System, has set, well, they're huge, of course, but they've set several $100 million aside to invest, particularly in what they call a green wave. And it's going to focus sometimes in a lot of California companies. But the philosophy is very much what you're talking about. What's the positive impact these companies are having, and how can I invest in a way to make my dollar help that? It's not a different philosophy than what we're discussing, but it's a different set of it, isn't it?
Another question?
Yep.
I would like to add something for that comment that he said. I think companies also have to look the corporate social responsibility locally, national, and globally. That's a key. You cannot focus just in the global side and not see the national and the local side of CSR. The other thing I want to add is that it has to be also an individual social responsibility inside a corporation. A corporation is made by individuals. That's what a corporation. Every individual can be a corporation, correct? You have eBay with 19 engineers making $19 billion. But it's individual responsibility to move it to a corporate responsibility, to move it to a global responsibility.
I like that. Yes, it's a very important reminder. We're talking about the three levels: global, national, and local. And your point about the role of the individual in the company is interesting too, because it goes back to Trevor's point. Companies have limits, but there can be individuals in a company who say, well, I think we should stretch a little further here. So let's take an example, which is very hard, and I'm not sure investors are beginning to argue with companies that this should be their responsibility. But if you go to a UN Global Compact meeting and you run into all the companies that are there, you also hear people talking about global poverty and the responsibilities of companies to address that. Now, you want to talk about a real stretch goal. This isn't just how do you make your product and do you do it responsibly. It's, do you have a responsibility to try to create change on a huge global issue? And a lot of companies, I would have thought, would just say, you know, that's very important, but it's not our job. It's government's job. But at least at this last meeting that I was at of the UN Global Compact, there were 100 companies there who said, we can't take it on as if we're a government or if we're going to do this in a kind of a magic way. But we do commit to play a specific role, whether it's doing a special kind of job training or dealing with some special health needs, whether it's HIV, AIDS, or malaria kinds of concerns in a country. So Coca-Cola, for example, in Africa does, and ExxonMobil does talk about HIV, AIDS, and malaria in a way in which they're making a difference. So, and this isn't philanthropy. This is part of how they're doing their business. I think that's one of the big new challenges companies are going to face. It's very hard to frame, And it is getting out of the comfort zone, isn't it, into something that says, whether it's global climate change or global poverty, if our whole planet is deteriorating around us, or population growth has made poverty even more extreme, is this going to be good for the business climate and ourselves?
Tim, let me ask you
one of the observations I ran into when I started mentioning this panel to people was, came from somebody who actually runs a fund, and he said, oh, social investment, that's a good way to lose money. And Katherina, I think you said that myth dies hard.
It does, and I actually wanted to add something to that point, because I think what you were saying addresses that issue of what role does the corporation play, and some people think it should be more active and some think it shouldn't. And what Tim said in his kind of case for the investors here, it's a new day, and he made a business case for corporate responsibility, and we had a discussion earlier before we went online, so to say, and I said, well, what about those instances where corporations might do something that is the right thing to do, but it's not going to have an immediate financial impact? Is that still part of corporate responsibility? And some of my students in the debates we had would say, well, that is the real social responsibility, because everything else is really good business, as Tim said. So we really had a fault line among our group and all the classes that I teach about what does that really mean. And I think in academia as well, I mean, we've been working or talking about this concept of CSR for many, many years, I would say even decades, and we haven't quite yet really gotten to a point where we can say, well, this is it and this is not it. And so I think what you're touching on is really sort of this, the edges of the debate and where it's going, and I think we still have to wait and how this plays out.
Tim, can I ask you a quick question about sort of thinking about this locally and how we define CSR? One of the things I'm curious about is how your firm and other CSR firms view philanthropy, and in terms of giving in the community or giving nationally. And to my recollection, we've never had a conversation with a shareholder about our corporate giving. I don't think anybody's ever come and asked us to give more. And so I would be curious to know what your perspective is on corporate philanthropy efforts.
Just before Tim responds, we have to excuse Katherina. She has a class upstairs, and I want to thank her for being here today.
Thank you.
Tim, go ahead.
Well, perhaps being a Twin Cities company, your reputation precedes you. I mean, we're very aware that you and many companies in the Twin Cities for decades have been leaders in this area. And this is one of the issues that investors like ourselves look at. Perhaps one of the reasons you haven't heard from folks like us is you have such a stellar, and I'm not just saying that, that's pretty clear. The record is very, very clear.
But this is something you're focused on and is a positive attribute.
But I think we would also look at not just philanthropy, meaning we'd encourage some companies not just to give to the opera, but to try to make a difference in communities. And we have, folks who are right here from the University Bank and others that are making a difference in the local community here in a kind of a grassroots way. So we haven't had that conversation, right? Our fault. But yes, we both want to commend you, but we'd want to try to encourage you to look at new ways, because many companies are doing.
I wasn't looking for praise. I was just curious.
That's all right. I want to go on to say new ways in which philanthropy can really impact on the local level. So I'm going to make one other point about the returns question. Very, very important question, and it really needs to be put on the record here. I was chair of the board of the Social Investment Forum for 5 years, and we have scores of studies, including one that's a meta study that came out a couple of years ago from the UNEP, which indicates that you can receive a competitive return investing in this way. And the myth, the Wall Street Journal is never going to give us that point. The myth is always going to be, gee, if you don't invest in Philip Morris, you're going to lose money. Well, you are unless you chose a good substitute. And the final point I'm going to make there, so you're not just hearing it from folks like us, is Goldman Sachs has created an investment product called GS Sustain. And it looks at about 35, 40 companies. I think some of them are Twin City companies. And they say these companies are going to outperform in the next decade because the companies are better attuned to deal with sustainability issues. Straight investment analysis, it's not about these are good guy companies, we feel really good about it. It's these companies understand a new context within which they're doing business. We think it's going to make more money for you as an investor. I hope they're right. Goldman Sachs says it, so I've got to give it a little respect. We haven't said it that way, but we can say with assurance, we're never going to get an institutional client to choose us if we can say we're a really responsible investment firm, but you're going to get a little less return. They'll say, we're really glad you're an good investment firm, or excuse me, a socially responsible investment firm, but we're taking our business elsewhere. We have to compete by showing we provide competitive returns, and we can.
We got one here from Ken, and then there's another one up here.
I have a puzzle about responsibility. Maybe file this one under be careful what you wish for. Most of the people in this room, I would guess, have no trouble making a distinction between responsibility and compliance. That is, they see compliance as a company being responsive to an external force and being obedient. Do what you're told. I used to have a colleague who chastised me for hoping that corporations could have consciences, because she said they're really like puppies and you need to use a newspaper, not a conscience, for corporations. But the whole idea of compliance is an externally imposed set of values on an organization, and usually by government. On the social investment side, it's as if the marketplace is demanding compliance through various kinds of screens and various kinds of pressures. And I'm putting myself in the position of the leader of a corporation who wants to say, enough with compliance already. We have our moral compass in this company, and we're going to follow our moral compass. And thank you for giving me the suggestions you're giving me, Mr. Government, and thank you for giving me the suggestions you're giving me in the social investment world. But if you want responsibility rather than slavery, then let me develop morally as a corporation. Does that question get a foothold in your experience, or is it just a professor's problem?
What do you think, Trevor?
Well, I think there's both components are alive and well in the CSR environment. There's a fair amount of newspaper swinging out there, but there is a moral compass, and I think the comment we got up there is that the corporation is made of people is a valid one, and those people have consciousness. And it's about leadership, and if you've got a conscience in leadership, then you're going to have the right compass. And I know, and I'm sure it happens elsewhere, but we have these debates and these questions, and they're framed not only in the context of who's wielding the newspaper, but what's the right thing to do. And so I am confident that those conversations are happening, maybe not as quickly as some would like, but they're happening, and corporations do have consciences. But I think it's a function of your culture and the leadership that you have, and whether that culture and leadership is one with a conscience. And it can be developed, and I'm proud of the company I work at, and I think we do a good job of it. But there still are occasions when we get hit with a newspaper, but that's all right.
Terry, have you got one up there?
Yes, first of all, Tim, it's great to see you here in Minnesota. I'm Dave Reiling. We've met before, and I maybe take you out of your comfort zone a little bit here in terms of, as a practitioner, as an owner of 3 community development banks that serve the underserved in this community. All the focus is always on the public and the institutional side, and I'm wondering if you're seeing anything out there relative, and it kind of goes back to the individual question over here and the individual question over there. Obviously, there's a lot of private capital that gets invested on a daily basis, whether it's private equity, venture capital, social entrepreneurship. microfinance, even people where they obviously dedicate their funds to bank accounts, and God forbid, family businesses who, for a lot of respects, it's the moral compass of the owner or the family institution. Do you see any research or any data or any type of trend or thought in and around that sector that doesn't have publicly disclosed data?
You should have been on the panel, David, not only for that question, but also because I did such a short shrift on community development investing, which you represent so well here in Minneapolis. And the trends report that I mentioned earlier does have a whole section about the growth of investors who are putting money into community development investing. It also, David, has a section on private equity and the growth of private equity in this space. Because there are people who, and venture capitalists, who are putting money to work much more on the cutting edge that you were talking about, to create solutions and make a difference. Not just, I'm going to stay away from a company that I don't feel comfortable with, but I'm going to invest in a company that's going to help transform maybe an issue in the third world, or maybe a question of a renewable energy source, that kind of thing. I'm not sure there's been so much written on, obviously, the small business owner and so on. I'm sure in the business schools there have been, but in our world, you might know that better than I, but I think there's a vacuum.
I would add one remark, and that is at the BSR conference last week in New York, Kohlberg Kravitz talked about using ESG factors in deciding what companies to acquire and how to run them. And that's a very large private equity enterprise. I've got a question here, and then we're going to go over there. So have you met him before?
I'm curious, one of the criticisms of American enterprise is that it's often driven by the quarterly balance sheet rather than longer term planning. I'm wondering what kind of impact automated trading is having on taking into consideration some things like CSR that clearly have a much longer term impact when the time window is no longer the quarterly balance sheet, but now it's seconds.
Seconds. What do you think?
Well, maybe we should do away with 10 Qs. I did hear a couple of years ago, I heard a speaker, I think from BlackRock, who suggested exactly that he'd be just as happy if he only read an annual report and not a 10Q, because he was concerned that it created a short-term perspective. And so I think there's some validity to that. As I said in my earlier remarks, I think by and large corporations are focused on long-term and long-term value. It's difficult to make those long-term decisions in the context of being measured every quarter or every day. But I think what the hope is, and I mean, I think you point out a reality. I don't know what the answer to it is, and do we feel quarterly pressure? We certainly do. The hope is, in the ideal world, your answer to the quarterly question is answered by the path you're on in the long run. And so if you've set the appropriate long-term goals, your milestones are going to be acceptable to people. And you may have a hiccup along the way, which you regret, but I think the long-term vision will take care of the short-term markers.
But you're absolutely right. That kind of investor is amoral. They're outside of this discussion. And in fact, the Aspen Institute did a study that had everybody from Warren Buffett to the AFL-CIO, not a study, a group, that were talking about long-term investments, investors, and why they were so important. And I think they're really hostile to the reality that you just quite properly described that exists, not for the ESG reasons we talked about, but just because these are investors who really don't have a stake in the company. They're sort of almost playing games with the stock. Mm-hmm. So I think Trevor did indicate that the company is pleased to see long-term investors, whether it's a pension.
Yeah, we love all of our shareholders.
But
our IR folks would acknowledge that the longer-term if we could have a stable of long-term investors, that would far and away be our preference.
So the 20 seconds in and out isn't quite what you're looking for. We've passed 6 o'clock. I'm going to take one final question. Sean?
Yes. We've touched on this a little bit, but I wanted to get back to Trevor's comment about what drives CSR activities within firms outside of simply investor motivations. And At the Net Impact Conference, we heard from Kim Jeffries, and he talked about integrated responsibility and what Nestle Waters is doing with their recycling programs and their investments in community recycling programs. And we know that Target gives 5% of their pre-tax profits to literacy, and General Mills with 82% volunteerism within their corporation. And I guess my question is, how do you communicate the business case for those activities? Do you need to communicate those? Is it an act of responsibility, corporate ethic, corporate conscience? Or within your investors, do you need to communicate that in a business fashion? We mentioned earlier attracting employees or community goodwill. How do you justify those programs, and how do you communicate those to the broader community?
It's very difficult. I would say there's no information that I've seen at our firm in the past 10 years that would even make an effort to or suggest that it's capable of measuring economically the benefit of the programs we're on. And you know, our CSR report gets longer every year, so it gives us all the feeling that we're doing more good things, but we don't do them with any expectation that you can measure the financial benefits of them. Some of them, as Tim suggested, the business case is inherent. It's self-evident because they come through the demands of your consumers and they come through the demands of your customers. Some of them have to do with the broader idea that corporations brand themselves as good companies. And that's an important part of your value and your brand proposition, is that you're a good company and that you're trying to do the right thing, and you take it as a matter of faith that pays its own economic benefits as well as, you know, your ethical benefit in terms of employees feeling good about their companies, communities feeling good about their companies, consumers feeling good about their companies. But if Caterina was here, maybe she'd have a better answer. We don't have an empirical measure of what the economic benefit is to us.
I think it is hard to do.
Yeah.
But I do hear more and more companies who are dealing with the climate issue, for example, talking about in two ways. We're avoiding risk, and we're going to try to enhance opportunities. So they don't just see it as staying away from the bad. They do talk about trying to be enhancing business opportunities. Now, for some, it's self-evident. I mean, GE has decided to make a business venture out of wind, right? But even in small ways, we see some companies talking, in smaller ways, we see many companies talking about both sides of that equation.
And I would just say that also, I think on the environmental side, you see definitely a lot more of that. I think on the social labor side, it's much more difficult to quantify. And it's often why people who work on issues that I work on much more in the social space are jealous of people in the environmental space, because they can make the business case and it's much clearer to companies about how you're saving and affecting the bottom line. But I mean, I think more and more companies, even internally, so I know Intel, for example, a lot of their sustainability initiatives, they're trying to quantify an ROI on. So I mean, I think that is maybe an area more companies will be looking.
Excuse me. Thank you. Is Lisa Byrne here, by the way? Come on down, because I know you've got an announcement. But I want to, while Lisa's coming down, I want to thank each of our panelists, and in absentia, Caterina. This has been really an interesting discussion, and I think this becomes a larger and larger piece of the puzzle year by year. Certainly heard a lot about it at the BSR conference, which had over 1,100 people in New York, and you get that same sort of impression when you go to the Boston College Center for Corporate Citizenship Conference. So this is definitely becoming closer, if not totally mainstream, definitely closer to the mainstream conversation. Lisa, you had a remark, and then I'll say thank you.
Thank you very much. I'm Lisa Byrne, graduate student from St. Thomas here. If you'd like to continue this conversation with Aditi, she is going to be speaking tomorrow at 3 o'clock at the Business Center at Capella Tower. And we will focus more on the women, board diversity, and social issues. So you are welcome to join us again. We're going to start about 3 o'clock. It's at the Business Center at Capella Tower, and students and faculty and guests are welcome. So thank you.
On behalf of the Center for Ethical Business Cultures and the Opus College of Business, I want to thank you all for coming. This has been, to me, a very interesting discussion, and please give our panel a round of applause.